Hello and welcome everybody. Welcome back to Sectors Made Simple, and today we have a very interesting topic for us to talk about. This week we got a lot of economic data, and this data was less than positive. Well, some of it definitely was positive. Well, some of it was definitely welcome news to us. Others, and the majority of it, not so much. So today I want to take a look at all of this economic data and what we can learn from it. There is a lot of information for us to go through here, and that information is extremely valuable for us because this week was a tough one for the market, and understanding the reasons behind it and the reasons why will help us to understand more what kind of direction we can see for the market moving forward. So we're going to go through today and look at everything. What happened to the market, the economic releases that are likely the reasons or some of the largest reasons for these market changes, and where all of this has, or how all of this has shaken up sector rotation. So let's get into it, shall we? So we're going to go through today and do a review of not only the FOMC today, but also all of the economic data that we received surrounding the FOMC. Also, I feel like my face is a little bit big. Let's try that. Alrighty. Let's get straight into it, shall we? Disclaimer, today is going to involve a review of data and also my opinion of that data. Please remember, when I share my opinion, it is not financial advice, it is my opinion. I will bring you all the facts, I will share the data that I've used to make my decision with you all, and encourage you to make your own decision as well. As I'll talk about later, right now, the amount of information we're getting is leading to a lot of uncertainty. That uncertainty is the reason that we are seeing so much change in the market. And it's really up to you to make your decision of where you think things are headed from here. So, take everything today as educational resources, not as financial advice. Thank you. All right, the goals for today's webinar. This week was tough for the market. From its peak on Tuesday morning, we saw SPY drop over 6% on the week, and much of the reason for this decline was due to a number of economic data releases that we got throughout the week. Now, in today's webinar, I want to review not only these economic releases, but also how all of that has affected the market. After all, we are a stock market company. We talk here about stocks. But yes, the economy also relates to stocks. The economy is, especially economic data, is our insight behind the scenes to understand what's really going on with these companies. So, or consumers as well. So we're going to review all of the economic data that we got this week, and we'll especially look at the really, really big ones. And there was kind of three of them that all went hand in hand. The FOMC meeting, the federal funds rate changes, and the summary of economic projections. And we'll take a look at some smaller ones as well, that if we just went by price changes, again, we can never just say, all right, this happened, this was the price change. But what we can say is, we can say, after this, here are the changes that happened to the market. And if we focused on that, some of these economic releases yielded larger shifts in price, negative shifts in price, than the FOMC did. First, especially for those that, you don't want to really know what happened with the reasons and all that, you just want to know what happened to the market. Let's cover the market first. We'll get the good stuff up front. So we can start off by looking first at a day-to-day review of the S&P 500. This will give us a better idea of the days that were the largest in terms of price changes and activity, and will help us to understand a little bit more just how much weight the market might have put on these different releases. Monday, we saw a minor uptick, but for the most part, it was mostly stagnant, because on Tuesday, we received the CPI inflation. Oh, getting ahead of myself. Tuesday, price-wise, we saw a sharp spike in the morning, where the S&P opened way above its Monday close, but slowly declined after its strong open, resulting in, yes, a net positive compared to Monday, but far below where any of us had hoped, given the size and importance of CPI inflation. Spoiler, that's what happened on Tuesday. Wednesday, we saw the end of the FOMC's meeting, the release of, again, getting ahead of myself, prices. Minor price changes. We saw very little movement as the market waited for a big announcement at 2 p.m. and immediately panicked and dropped 1.5%. And Thursday was no better, because Thursday opened and the market was already down over 1% and only went down from there, ending the day at 2.5% lower than its Wednesday close. And finally on Friday, today, markets opened low once again, and prices slowly slid down into the midday and then did have a slight recovery in the last hour or so of trading, resulting in a net 1.5% or 1.6% loss for the day. Now, our sectors made simple. Understanding how all of these changes affect sector rotation is kind of our thing. Let's go and do our thing. All right. Let's take a look at how all of these changes affected market sectors. If we look first at what sectors saw point and figure signals, so buy or sell signals represented by breakouts or breakdowns, respectively, we find that 3 different ETFs all yielded sell signals on the week. Hello, Cleo. Yes, that's a microphone. You don't want that, though. So we saw that SPY went on a sell signal, discretionary, and technology. Additionally, while they aren't on a sell signal yet, we did see reversals into negative direct price direction columns of O's for 4 sectors as well: communications, industrials, materials, and utilities. If we look beyond the sectors and look at the companies that make them up, what we end up finding is that a number of different sectors all saw more companies going on sell signals than they did on buy signals. Bullish percent index, or BPI, is a number that allows us to see what percent of companies in each sector are on buy signals. When we see that number start to go down and go into a downward trend represented by O's, that means that more companies are going on sell signals than buy signals. So in that group, we find the S&P 500 itself, materials, industrials, technology, and discretionary all saw reversals into columns of O's. Finally, if we look at prices, what we end up finding is that we saw ETF losses across the board for everyone except for energy. Energy did see just over 1% gain on the week, but losses really ranged from -1% to 2%, with discretionary seeing the largest loss at almost 4%, with a loss of 3.8%. That's all I'm really going to talk about for the market sector side of things. But, that's the same slide. My apologies. Let's now look at sector leadership changes. By comparing relative strength every day, we're able to see how sector leadership, and really what strong sectors we have, changes over time. So we did see some sizable changes in sector leadership, which is represented by this chart right over here, where green boxes indicate gains in relative strength, whereas red boxes indicate losses in relative strength. Positive trend, or pause trend, refers to long-term changes, while short-term changes are represented by the X count, with total count being 1 plus the other. When we take a look at this, obviously, energy was the only company to see profits this week. Energy is also going to be the one to see the largest week-over-week change for relative strength. Looking below that, what we find are a number of sectors that actually picked up long-term relative strength. But, of course, that's not going to be the focus on this because there is clearly a lot more red than there is green on this chart. We did see the majority of sectors lose relative strength, with the largest losses occurring in technology and SPY. But utilities is not very far behind, which is extremely interesting considering something that we'll take a look at later. But moving along from the 1 week changes, what we can find is our current sector leaders. This is a view that we always provide through Sectors Made Simple that gives us the best idea of what sectors are leaders in any given moment. The higher the number, the stronger the strength. What we find is that materials, XLB, is currently our sector leader, and then a three-way tie for healthcare, utilities, and industrials. You don't want to be nudging up against that mic. I know it might have some fuzzy sounds coming out of it, but you don't want to be nudging up against that. I know that cats usually try and chase mice, but right now she's trying to chase my mic. Par for the course. We see a three-way tie for second place between healthcare, utilities, and industrials, with staples close behind at 15. What's extremely interesting about this, though, is that right now we see sector leadership heavily overweighted. Now, that's not because price is overweighted. I think that everyone can say price is not overinflated right now. But when we see relative strength like this, it's an indication that things are not settled. If things are settled, if we know sector leadership, we expect to see an average somewhere around 11. The highest we can have is an 11. The lowest we can have is a 0. So if the max is 22, the lowest is 0, and everything is compared, a average would be around 11. Clearly, the average is well above 11 right now. So what that's indicating is that we are far away from what we can consider to be balance in terms of relative strength. So while this might be the matrix right now, I'm going to keep an eye on it. Personally, I think that we are going to see over the next week or so some pretty significant shifts in sector leadership. This big pack of people between 15 and 16, I don't think that's going to last. I think that that's going to be gone, and we'll actually get an understanding of what sectors are leaders in the coming weeks. Now, the last thing I want to take a look at for prices is taking a look at the S&P 500 companies and seeing how these companies performed. Note, this data we calculate daily, but it takes quite a while to run. So while we are doing this webinar live on Friday, December 16th, the data that we have currently is up through Thursday, December 15th. Regardless, we can use this data from our S&P 500 screener to understand which companies gained or lost the most strength over the last week. Just like we can compare 11 different sectors and SPY to find leaders, we can do that for the S&P 500 companies as well. There's just a lot more comparisons. So with this, we can not only get an idea of what companies are gaining or losing the most strength, but we can also see the averages for every sector. Whereas BPI is equal weighted, it's not a representation of relative strength. Whereas the matrix is capitalization weighted and gives us relative strength, it doesn't give us equal weighting. The smaller companies, in that case, don't matter as much. So sector averages is probably one of our best indicators as to what sectors are overall the strongest in any given moment. It is equal weighted, it is representative, and it's comparable. So we have a way of comparing the relative strength of all of these sectors, just like we can do for the matrix as well. So let's go ahead and take a look at that data and see what it can tell us. So if we go over here and pull up the matrix, what we end up finding, give me a moment, that's the wrong thing. That is definitely the wrong thing. All right, we're just going to roll with this. All right, what we end up finding is under the S&P screener, we end up finding that currently it's loading. Again, this is loading a ton of data. This is quite literally 250,000 stock charts analyzed every day. So what we end up finding is down below, if we look at what companies have gained and lost the most strength over the past week, we can sort by short-term X count. And we see slight weighting towards energy, but overall a pretty good spread of different sectors. Again, this is definitely trending a little bit more towards energy companies. We look instead at the total count though. Things get pretty diverse. We end up finding that CRL in the healthcare sector by over 200 has the largest gain in relative strength this week. Looking further down, we again see a very wide range of sectors. We definitely see the more defensive sectors holding ground, although utilities is a little bit further back. What we're not really seeing, though, is one sector or one class of sectors being the clear winner. Communication services, there are companies performing well. In healthcare, in cyclical, in discretionary, the sector that got hit the hardest this week still had a number of companies perform extremely well in terms of relative strength. And again, once we start to get down into the range of 40 to 50, we do see some utilities companies here as well. Now, that's all well and good. But I kind of went on a little bit about why sector averages are such a valuable way for us to be able to understand sector leadership. Because if we take a look at that and we sort by total count, we see a slight difference. Remember, this was our relative strength before: materials, healthcare, utilities, industrials. Utilities, healthcare, real estate, staples, discretionary, industrials. What's going on here? And we're not just talking a small difference. We're talking utilities is almost 300, sorry, that's not how math works, 200 higher on average than industrials is. In this case, the largest number is 500 for X count and positive trend, and that means the largest is 1,000 for total count. So there is a significant difference between what we are seeing on the matrix and what we're seeing in terms of sector averages. And there's a lot that we can go into here and start to break out. All right, here is where we can assign more weighting to large cap companies, small cap companies. That's not the focus for today. What I want to be the focus for today is the fact that for many of these sectors, energy, for example, if we sort this by X count, we find energy number 2. For positive trend, dead last. There is a number of sectors that have significant differences between their short and long-term strength. Once again, indicating that right now there is a lot of things that aren't decided in the market. And we don't need wide price changes to have those changes occur. Relative strength has this beautiful trait of just being pretty responsive to when shifts occur. And all of these sectors with large imbalances between their short and long-term strength, we can hope that there is resolution, but also a more clear hierarchy. What sectors sit above others when all of this finally settles? So 2 things that we can keep an eye on this matrix are going to be these sectors with the large imbalances, and on the matrix itself, seeing this large pack up at the top start to finally break down into more of a normal leadership structure with an average somewhere around 11. Now, that was a lot, but let's start getting into the reasons. First, we had to do the market review and understand what happened. Now we can go into why. And also, what should we think about it? We're going to go back to our day-by-day breakdown from earlier. And move my face a little bit more out of the way. Ta-da! Messing around with the green screen, so there might be a couple of little weirdness as we try and iron that out. Not iron out the green screen. It's actually pretty nice, but iron out the technology side of it. Now, we're going to look at the day-by-day breakdown of what's changed in all of these economic releases and how those have affected the market. So, day by day, let's see what economic data we got. Tuesday, we got November 2022's CPI inflation data. Wednesday was the headline day, where we got the FOMC meeting, or the conclusion of the FOMC meeting, because that also took place on Tuesday, federal funds rate changes, and a new summary of economic projections for the year end of 2022. Thursday, we got data on November retail sales in the United States, the industrial production indices, as well as December manufacturing index data. And finally, on Friday, we got Standard & Poor's service and manufacturing price measured index data. A lot of stuff, right? So we're going to go through each one of them. We're going to do a little bit of a description of what it is and why I'm even talking about it today. We'll talk about what the numbers were. Oh, here. I can explain how we're going to do it, or we can just do it and see how it's going to work. Let's do that. So, November CPI data. What it was data on the rate of inflation in the United States in November of 2022 compared to October, but also compared to the same period, November of 2021. These numbers, we saw a headline CPI, so that is the number that probably everyone's going to talk about in news articles and all of that. It includes most of the things that a urban consumer will buy. And yes, thank you, Melly. CPI stands for Consumer Price Index. We saw the headline Consumer Price Index be 7.1%. This was down from 7.7%, which is sizable. Again, inflation right now, if someone knows nothing about economics, they're going to know that their Chipotle burrito costs quite a bit more now than it did last year, especially more even compared to the year before. The estimate for this month's release was 7.3%. So we beat it. Inflation's lower, which is, again, good thing in this case. Behind the headline CPI, we have core CPI. This is going to be the same inflation index, but without food and energy, which are deemed to be two of the more volatile industries. Now, in this case, sectors and industries. For the core CPI, we saw that rate be currently at 6% year over year, which is down from 6.3% the previous quarter, the previous month, and compared to its average, or compared to the estimate, rather, of 6.1%. So both headline and CPI performed better than they did previously. Additionally, this is the second month in a row that we have seen both headline and core CPI decrease, and the first time in 2022 that we have seen 2 months in a row with both headline and core CPI decreasing. Obviously, very welcome news. So, how did this affect the market? They celebrated and then stopped. We saw a very strong market rally first thing in the morning with the release of the data. The market corrected midday and did actually close up on the day. One of the few positive days that we've actually had this week. Actually, I believe the only positive day that we had this week. Now, we talked about the really good news for economic data. Let's go into the so-so news. The FOMC meeting. This meeting is the Federal Open Market Committee, group of economic policymakers who are members of the various Federal Reserve branches around the United States, getting together and talking about the most recent book that the current state of the U.S. economy. They've got bigger things to talk about than a book. So they're going to talk about the current status of the U.S. economy, where they feel things are going and the changes that they feel they need to take to try and push things in the right direction. So, they met on Tuesday and Wednesday, and at the end of Wednesday's meeting, Chairman Jerome Powell announced what changes the Fed would be making, the status of where they see the US economy and where they feel it's going, and how all of this will affect the federal funds rate. Again, that interest rate that sits below everything. As the federal funds rate goes up, what usually is expected is that inflation goes down, but at a cost. That cost being that loans for both consumers and businesses go up, and the risk of a recession increases as well. So let's start off with the big one here, the federal fund rate changes. The federal funds rate, again, is one of the ways that the Fed can try and manage monetary policy and direct the US economy in the direction they feel like it needs to go. The federal funds rate allows them to do this by setting the rate that banks can lend to other banks. Silly sounding, I know, right? Banks don't have enough money, they need to borrow? Long story short, yeah. So, whenever you look at a loan, consumer or business, all of that is going to sit on top of the federal fund rate. If the federal fund rate is 0, we're probably going to see interest rates much lower, with prime interest loans looking somewhere in the range of 2.7 to 3%. As that rate goes up, or as the federal fund rate goes up, so does the loan rates that we can expect to see. Excuse me. So, obviously, federal fund rate going up is not a positive thing for the market. That means that the Fed feels they need to get more involved, try and tighten up monetary policy, and make things a little bit more of a crunch. And the point of that, again, is to try and bring the rate of inflation back down under control. A little bit of inflation is good, the range of 2 to 3%. We're cool with that. 7%, not so much. So on Wednesday, Jerome Powell spoke about the current rate of inflation, and that while it is moving in the correct direction, it is nowhere close to where it needs to be, and that the Fed is announcing the final change for 2022, a 0.5% increase to the federal funds rate, raising that interest rate up to 4.25 to 4.5%. Now, the expectations were a little mixed. We expected to see a change. The optimists, the people who were looking at it with a glass half full, wanted 0.5%. The people that were a little bit more pessimistic were expecting 0.75%. So this was definitely on the lower end of that. But at the same time, this is also the highest we've seen the federal funds rate in 15 years. The last time we saw a federal funds rate higher than this was December of 2007, right at the beginning of the Great Recession. Now, again, this doesn't mean that we're about to enter the Great Recession Part 2. This just means that this is a pretty high federal funds rate, especially if they continue to increase it. So in addition to this meeting, we got an idea of where they expect things to go from here. The federal funds rate portion of all of this was the calm part. The summary of economic projections is where things got a little bit more interesting, and not for the best reasons. Every quarter, to end their meeting, the the FOMC rather, and the Federal Reserve branches provide everyone with what they call the summary of economic projections. It is the Fed's forecast of where they feel key economic indicators from GDP, unemployment, federal funds rate, and more will be over the next few years. They looked at before we got to the end of 2022, they looked at 2022, 2023, 2024, 2025, and longer run. This report is 17 pages long. If you feel economic data is very interesting, it is a great read. It is in the chat now, and if you're watching this recorded, it'll be in the resources section either below the video, if you're watching it on our site, Sectors Made Simple, or it's over on or in the description if you're watching this on YouTube. If you're watching this on YouTube, please hit the subscribe button. It does help us out quite a bit. We like seeing numbers go up. We're investors. We like the number going up. Alrighty, let's actually cover what this summary gave us. Again, I'm not going to go through all the details. I'm not going to try and bore us with a bunch of statistical data. I'm going to focus on the things that I felt were the most important. But please, if this is the kind of thing that is interesting to you, go and read the full report. It's not as bad as it might seem, and the information in it is very valuable. Let's start with the big one, GDP. If you talk to someone that knows nothing about the economy, and they just finished up their freshman macroeconomics class, and you ask them, what is a recession? They'll probably say, recession is 2 consecutive quarters of GDP losses. All right, cool, thanks. In reality, it's much more complex than that. But GDP is one of the big metrics that people look at to try and understand the health of the US economy. It is how much stuff we are producing. So a GDP going down is not a recession, but is a receding GDP. 2 consecutive quarters meets the textbook definition of a recession. Now, GDP estimates for 2023 in this final report took a turn for the worse, where we saw the median, which is the middle person, so they take best and worst, second best and worst, all the way down to the middle guy. The middle guy says 2023 will have a 0.5% increase in GDP. Okay, so it's going up, right? No recession. Well, yeah, but it's also down from 1.2% just back in September. And if we look at the range, which they ask the most optimistic and the least optimistic guys or gals, it's a range between negative 0.5, so a loss of 0.5% GDP, and positive 1%. This is a decrease on the low end by a little bit. We went from negative 0.3 to negative 0.5. But the best estimates tanked. We went from 1.9% to 1%. That is a pretty sharp drop. Now, looking further, we can look at the unemployment rate. And their estimates for 2023's unemployment rate went up from the median, central tendency, which is, again, getting rid of those super optimistic and pessimistic guys and gals, and only looking at the middle bunch, and then the range, which is everyone included. All 3 of those saw increases between 0.2 and 0.3%. What that means, everyone is expecting that unemployment in 2023 will be higher than what they expected back in September. And finally, the federal fund rate. The federal fund rate, they are expecting to peak in 2023, with their estimates for where it will end up being somewhere between 4.9 and 5.6%, with a median estimate of 5.1%, which is a 0.5% increase compared to September. What does all this mean? How can we summarize all of this? What this tells us is that after that positive CPI report, that was not enough for the Fed. They want change. They want it quick. They're not quick, but they're going to see about that change. So seeing their projections move overall negative compared to where they were the previous month is tough. That's not positive news, especially in comparison to the CPI data we got the day before. Now, as the Fed not only increases their estimates of where they think the federal fund rate will need to be, yes, we just talked about how GDP has the worst estimates are expecting slightly negative GDP, but the best estimates dropped quite a bit. And unemployment is expected to be a little bit higher than it previously was. We got to realize that the federal fund rate is what they have the most control over. So by them saying that they are planning to increase the federal fund rate about 0.5% higher than their September estimate, that's a caution sign to many investors and many economists, feeling that we're not moving in the right direction and that we're running the risk of getting closer and closer to a recession. As a result of this, the S&P 500 immediately, quite literally, if you can go and look at a daily chart, flat, 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 2 o'clock, plummet. Immediately dropped 1.3%. And Thursday's data did us no more favors. The first one I want to cover is November's retail sales. This was data on the sales of, go figure, retail stores in November of 2022. Why this is so important? There's a big holiday that involves a lot of overindulging and celebration, but also a lot of fighting. Black Friday. Black Friday is one of the largest days for retail companies across the US. So November is a really big month to look at retail sales. And what we saw was that sales declined 0.6% compared to 2021, and 2021 compared to 2020 was an increase of 1.3%. 0.6% doesn't seem like a lot, but the estimate was just half of that. The estimate was negative 0.3%. So when the real numbers come out and they're twice as bad as you were expecting them to be, that's going to be a shock to everyone. Moving along, we get the manufacturing indices. These manufacturing indices are a monthly survey of manufacturers regarding the direction of their industry. Now, this is one of the bigger metrics that takes in a lot of different factors. So I'm not going to get into the calculations or any of that. All we're going to look at, what was the number, what was the estimate, what was the previous number. Keep it simple. For this, we get two different numbers. We have the number by the Philadelphia Fed, which they reported a change of negative 13.8 compared to negative 19.4 the last period. So an improvement there. But again, we fell short of the estimate. The estimate was negative 12. We had negative 13.8. The second manufacturing index that we received was the Empire State Manufacturing Index, which reported a change of negative 11.2. This was compared to 4.5, a positive 4.5 from the previous period, way underperforming the estimate. With the estimate being negative 0.5, we had negative 11.2. Again, bad news, worse news. And finally, the Industrial Production Index was the final piece of data we got on Thursday. This is another index that we can use to measure the production and capacity of the industrial sector. And the numbers here, once again, we saw a decrease when the expectation was not even, we expect losses, but not bad ones. This was, we expect growth, and instead we see losses. So how did the market respond to all of this? Well, remember when I said before that the FOMC meeting is the biggest for the headlines, but might not be the biggest for prices? Well, yeah, because Thursday's releases tanked the market 2.5% compared to Wednesday's market close. And Friday didn't help. Friday, today, we got the Standard & Poor's US Manufacturing and Services Indices, the Purchasing Managers Index. These measure the business conditions in the manufacturing and services industries. This takes into account a number of different factors, including labor costs, transportation costs, warehousing, and all of the costs that go into delivering services or manufactured goods. So what were these numbers? Manufacturing, we saw a decrease from 47.7 down to 46.2, a loss of 1.5. The estimate was meant to be flat. It was expected to be the same as it was the previous month in November. Services, again, they expected growth. The estimate was an increase from 46.2 to 46.5, and instead, we saw a loss, dropping the services index down to 44.4. Now, I want to go one step further here. I don't want to just talk about what the 1 month changes were. I want to compare these to the changes compared to the highs of this year. Both of these indices had highs back in April of 2022. The highs for these provide context for just how far these indexes have fallen. For manufacturing, we had a high in April of 59 and 58 for services. I don't think you need me to tell you that a decrease of 20% is substantial. Underperforming both of these metrics, especially when one expected growth, is a big blow. And once again, as a result, we saw the market drop again. There was a recovery towards the end of the trading day, but it wasn't enough to make up for where the market opened, closing us today down 1.2%. We looked over a lot of information. We looked over prices, we looked over economic data, how the changes in those, or how the expectations in those economic releases affected prices for SPY, and didn't really talk about, outside of 1 week price changes, where does all of this leave us? And the reason that we haven't talked about it is because no one knows. If someone tells you they think they know exactly where the US economy is headed from here, I wouldn't believe that. There is not a single person that knows where the economy is headed from here. If you watched last week's webinar where we talked about price estimates and price targets, we went into detail about how important it is to not only look at one person's opinion, and instead to look at everyone's opinion. For some stocks, it might be as big of a shift as 600% the current stock's price between the lowest and highest estimates. Economic data is no different. So anyone telling you that they know where things are going, no one knows. I don't know. I have my opinion. So before I get into my opinion, the reason for providing you all of the data that I did today, not only saying, here's what you should think about it, or here's the data release and here's the results, I want you to understand the whole picture. It's all of the data releases, not just the ones that give you a good or bad story. It's everything. Boring, important, and every combination in between. So that you can make your own decision, your own educated decision, based on the data and the facts. And again, I've tried to provide all of the data that I could find to understand what happened this week in this webinar. Reviewed all of the economic data releases, reviewed the summary of economic projections, and while I have tried to provide an overall look at it, this amount of data is overwhelming, but also is very, very short-sighted. It looks strictly at where we are right now and doesn't really leave us much idea of the forecast of where things might be going from here. The only forecast we really get is the summary of economic projections. Now, again, I just said, if someone tries to tell you what you should think, run the other way. I'm going to tell you what I think, that there is currently only one certainty. Nothing is certain. No one knows where things are going from here. No one knows if GDP is going to be positive or negative. No one knows if we're going to fall into a recession, and if we fall into a recession, how bad it is going to be. The Fed is still dedicated to trying to bring down inflation without dropping us into a recession. That's great and all. Congratulations, great job, United States. We are not the center of the world. There are many economic indicators that we've looked at today within the US, but it's not just the US. Inflation is not just a problem in the US. The rising gas prices and energy prices are not just a problem in the US. So it's silly to think that this is strictly a US problem, because if it was, it'd be way easier to solve. It's not. It's a global problem. The concerns right now from many seasoned economists are that they are more worried about a global recession, not a US recession. And that's not great news. But again, everyone's going to have an opinion of where they see this data and where they see things headed from here. No one knows for certain. Even the Fed is not perfect in their estimates, as we've seen right now. They have wildly different results, even quarter over quarter. And again, if you read through the entire report, at the very end, they have the mean standard error of the different indicators they provide. So they tell you how accurate are these numbers over the next certain periods. Again, valuable stuff to know just how close they can be. And it's a realization of oftentimes they're not really that close. It could be off by over a percentage point. Now, I could go on and on about this. Just going to get straight into my opinion. And again, I fully encourage you to have your own opinion as well. Don't just take my opinion and be like, all right, sure, his. No. Make your own opinion. Do your own research. Find your own facts. I've provided you all the facts that I've found today, both using our Sectors Made Simple tools, but also using economic data releases, and try to put all that together to understand where things sit right now. Now, my opinion, again, I might be an outlier here. I'm still optimistic that we'll be able to avoid a full recession, and instead can achieve a soft landing. Soft landing is a term that the Fed has shared numerous times over the past year, but have definitely slowed mentioning in the past few announcements. Does that mean that I think they've ruled it out completely? No. I think that they would be very clear if that was not the case. Their goal is not to mislead people. Their goal is to take the facts that they have, try and use what power they have to make change, and then monitor those changes. What I'm seeing right now is not the Fed giving us bad news that we are going to be in a recession and they're trying to do damage control. And instead, it is we are more focused on maintaining the current direction of things, not trying to make things any better or worse than they are. Now, if we just focused on the GDP, a GDP loss at their worst estimate of 0.5% loss is far better than the recession of 2008. So people comparing this market, this atmosphere to pre-2008 doesn't really seem fair to me. Unemployment's not anywhere close to what it was in 2008. The reasons for the crash in 2008 and the financial crisis of it are not here. Everything is different. And again, the recession of 2008 saw very, very, very high GDP losses. But again, I want to give both sides here. I don't want to just only show you the side that proves my point. Because 0.5% is within the range of what we saw in the dot-com bubble in the early 2000s. So, do I expect this to be the Great Recession Part 2? No. Do I think that the fact that GDP is at worst going to be negative 0.5, an indicator that we're not going to be in a recession at all? No. I'm not going to say that we're definitely going to avoid a recession. I'm hopeful that we can avoid it. There are other portions that go into a recession that current estimates and current projections don't show. Unemployment is expected to rise, but not get out of control. There's a lot of different factors that go into this that provide both reassurance, but also contradiction to trying to figure out where we really are sitting. So the biggest benefit that I see is the fact that GDP is not expected to tank, and that we should be able to, there is a decent probability that we are able to weather this without significant damage. And by damage, I don't mean GDP. I mean the things that really matter. Unemployment, the ability for people to pay their bills, those things, the things that matter to us, not just in the we'd like to have more GDP, I need to be able to pay my bills. And I need the bills to not be sky high. I'm hopeful that we're able to actually see about change in that area much sooner than we will be able to see a complete reversal into a positive direction. Now, along those similar lines, the biggest problem that I see is not in GDP. It's in something entirely different. It's the fact that right now, and again, do I have concrete data to show this? There are pieces of data that I've used to make this decision or this opinion, such as consumer confidence, consumer spending, and retail sales. Those kinds of different economic data indicators. But this is more just an anecdotal thing. Right now, there is huge issues with how much people are making, the cost of living for them to be able to maintain a lifestyle that's reasonable, how people, and by people I mean workers, are being treated compared to the company profits that many major corporations are posting. Corporate profit is extremely high right now, and it seems very disconnected from the troubles and movements that are happening for better compensation and better conditions for workers. So, while I remain optimistic that the overall economy can move forward in a positive direction, my biggest concern is not in the short term of are we going to avoid a recession or not. It's the fact that one of the biggest problems right now is inflation, but also is this massive imbalance between taking care of workers and employees as opposed to trying to maximize corporate profits. Many companies, and again, I have zero concrete, I can point to this one research study to prove this, but it feels that many companies right now are increasing their prices, are quoting inflation as the reason for those increases in prices, but the price increases are well outside of what inflation would be showing, and that profit is increasing, but how much people are making isn't. So when the cost of everything is increasing, people aren't making more money, that's going to contribute more to a recession. So it's almost this kind of push towards a recession almost of people are not making enough money. Things are getting more expensive. Corporations are making more profit, and none of that is making its way down to the people that have bills to pay and end up needing to be consumers within the US economy. So, in my opinion, I think we'll avoid a short-term recession. We will see a little bit more pullback, but I feel that the market is generally trending towards a bullish market. But my biggest concern is not in the short term, it's in the more mid to long term, with concerns that if we actually don't see real improvement, if we kind of just look at inflation as, all right, inflation's back under control, without tackling the real reasons of why inflation got so bad, we're going to have it happen again, and it's going to be worse. It's almost one of those things of, if you try and delay it for too long, it's going to get worse. My concern is that we might see that happen, provided something doesn't actually change. How it changes, exactly what it changes, I don't know. We're now getting into the world of policy well outside of economic policy, and that's not something I'm going to talk about. But that's it. That's it. It's a lot for us to review. There is a lot of economic data that came out this week. The market responded very poorly to the vast majority of that economic data, and understandably so. But we got to remember, look outside of just 1 week, look a little bit more long-term, and try and follow the direction of where things are headed. The more long-term indicators, such as unemployment and the current direction of inflation, are not immediate cause for concern. There are less quantifiable things, like I was mentioning before with compensation and consideration for workers, that I feel are the real challenges. And while those might not come through in economic data, they definitely will come through in things like earnings. So I'm keeping a pretty close eye on the year-end earnings reports for many companies to try and get better insight as to, is corporate profit actually as high as many people believe it to be? And if it is, where's the employee's piece of the cut? Again, that's a topic for later, and that will be a topic for later when we do our earnings reports review, as we do every quarter. But until then, I want to bring things back to a brighter note. This was a recap of the market. It wasn't here to tell you everything's fine. It was here to give you the real look at what's changed, why it's changed, and some potential data that we have to show where it would go from here. This is the last big piece of content that we will be doing this year, but we're not going away just yet. Come back next Friday. We've done a lot of changes here at Sectors Made Simple, and if the attempt at a green screen has been any indication, there are a number of changes that we plan on making in the new year as well to help you all invest simpler, both in and outside of Sectors Made Simple. So, if you're interested, come back next week as we do our 2022 review of Sectors Made Simple. Take a look at what's changed, as well as some of our plans for the new year. So thank you all so much for joining us today. Take care, everyone.